Hey, good morning, options traders, and happy Wednesday to everyone. And I've got another really intriguing question for the group, and that is how far back do exponential moving averages remember? Now, of course, they don't really remember, but when we talk about this in the world of technical analysis, it means how far back does an EMA go before it starts not really counting those closing prices? And this came up as a question from one of the traders in the group because he said that he was using a 20-day exponential moving average. And he said after 20 days, therefore, those prices drop off. Well, that's a simple moving average. It's not an exponential moving average. And you need to understand the difference in how to figure out how far back these things remember or which prices they consider, because sometimes you don't want them to look that far back. So how do you do it? How far back do EMAs remember? It's a good question. Let's go find out more. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So to understand an exponential moving average from a simple moving average, its counterpart, let's start with the simple moving average, and it'll make things a lot easier to understand. So these are some closing prices from NVIDIA, some actual closing prices. And if we are doing a 9-day simple moving average, and I'm going to choose a 9-day because it's just going to make the math a lot easier and the pictures a lot easier to follow. But what you're going to do, or what the computer will do, is it's going to look at, let's say, 9 closing prices. So everything inside of this red rectangle, it's going to add them up and divide by 9. It's just a straight average. And in this case, we get 176.95. That's just the average of those 9 prices. And then what happens is that the window slides forward one day. We have another 9 closing prices in the window. We add those up, divide by 9, and now we get 177. And you can see that when the window slides forward one day, that we drop this guy off right here. So that's sometimes a drawback to simple moving averages, that yesterday it was included in the count. It was accounting for 1/9 of the weight, and the very next day it completely drops off. And that's what this trader's question was. He was assuming the same thing happens with an exponential moving average. As we'll soon see, that is far from true. So back to the simple moving average, what happens next day? We slide forward a day, and we have another block of 9 days. We add up these 9 numbers, divide by 9, we get 177.77. And this process just continues each and every day. But again, notice how the oldest price got completely dropped off. One day it's there, next day it's gone. So that's just a simple moving average. And let's jump over to Tasty Trade and take a look at what it will look like on your chart. So here's a chart of NVIDIA, and we've got this white line here is the 9-day simple moving average. Normally I wouldn't use a moving average this short because, as you can tell, it just gives you very little information. But I did it just to make it easier to follow in the examples. But that is a simple moving average. And so if we went and plotted all of those averages that we just saw, that's what you're going to get, that white line. But now, what's different between a simple moving average and an exponential moving average? Well, when technicians were trying to tweak this so that it would have a little more sensitivity to market turns, they also wanted it to remember some of the past candlesticks. They didn't want it to have this abrupt drop-off, so that every day that, in this example, that we slid forward one day, we were dropping off that point that was 8 days old. Again, it's there one day and the next day it's gone. So they said, well, we really don't want it to cut it off that sharply. We want it to remember these past prices, but to kind of fade out. We don't want to give them a lot of weight. We want to give more weight to the candles up front. So that was the idea, but there was an added tweak to it. And the added tweak is that they wanted the exponential moving average to have the same average lag as a simple moving average. So what does that mean? Well, the lag is how many days does it take before the moving average responds, at least on average. So for instance, if the market turns up, we see the candlesticks turning up, it takes lag number of days before the moving average turns. So if we have a 4-day lag, markets turn up, we should see the moving average turn up about 4 days later. Now, it's important to understand this doesn't mean that your moving average doesn't respond at all. If the market turns up, don't say, hey, look, it looks like it's just starting to turn up. This is wrong. It doesn't take 4 days. What it really means is the bulk of it. It's taking the bulk of that information, and that's when it's turning. Where does that moving average start to capture the bulk of that information? So that's what they wanted. They wanted the exponential moving average to have the same average lag as the simple moving average. So how is that done? Well, again, if we have a 9-day moving average, the average lag is, how do we figure that out? Well, we're going to say we want to include today's price, today's closing, in other words, 0 days ago. We want to include 1 day ago, 2 days ago, 3 days ago, and all the way up to 8 days ago. So if we have the last 8 closing prices plus today, that's 9 numbers in there, divided by 9 gives us 4. And we can see that 4 is the middlemost value. We've got 4 numbers to the left, 0 through 3, and we have 5 through 8 on the right. So 4 is the average. And what this tells us is that if you're using a 9-day moving average, whether it's a simple or an exponential, that it's about a 4-day lag before it starts capturing the bulk of that information. So that was also part of the trick. We wanted this exponential moving average to capture more weight for the current candles. We didn't want it to drop off so abruptly. We wanted it to remember some of the past prices, but also we wanted it to have the same average lag. So again, the idea was for this exponential moving average, it should have the same average lag. It should also turn up before the simple moving average. That's why we are mostly interested in it. We want to get a signal sooner. So if the market turns up, we'd like to see the EMA turn up sooner. If the market turns down, we'd like to see it turn down sooner compared to a simple moving average. But again, it should also remember more of the past data. So that's a tough thing to do. How is that done? Well, the main ingredient for an exponential moving average is a number called alpha. And the way that it's calculated, I'm not going to show where the formula comes from, but it's 2 divided by the number of days in our moving average plus 1. So for an exponential moving average with a 9-day window, we would take 2 divided by 9 plus 1, which is 2 divided by 10, or 0.2. So this is alpha. This is another reason why I chose a 9-day exponential moving average for this example, because when we add 1 to it, we get this nice round number of 0.2. But we're also going to need another number, and that is 1 minus this number. So just 1 minus alpha would be 0.8. And if we have these two numbers, now we're in business. And this is all the computer needs to figure out the exponential moving average. So how is that done? Okay, so now we're into an Excel spreadsheet, and here are some of the closing prices from NVIDIA. So if we were to calculate an exponential moving average, we have to have a starting point. All moving averages do. So let's say that it's a 9-day moving average. We're going to count off 9 days, and we're just going to find the average. So if we type in average, we swipe that entire set of numbers right there, we have an average price of $176.95. So the computer's going to start there. And so now the next day, what it's going to do is it's going to take 20%, that's alpha, of today's closing price. And then it's going to add it to 80% of this EMA. So this is our EMA column right here. So let's say equals that times 0.2, again, that's our alpha, plus we're going to take the previous EMA up here times 0.8, which is again 1 minus alpha, and we get 177.2. So the process just continues. We drop down a row, we're going to take 0.2 times this, or alpha, plus 0.8 times this. Now you might think, well, hang on a second. It looks like we're only giving 20% of the weight to the current price and 80% of the weight to the previous prices. But this is really the secret behind the EMA. Notice that we took 0.8 times this number, but we also took 0.8 times this number. So we're always taking 80% of that, which is also saying we're subtracting 20% from it. But if we were to continue this down, now those are the EMAs. So think about it. If we took 80% of this number, and then 80% of this number, and 80% of this one, we're taking 0.8 times 0.8 squared times 0.8 to the third times 0.8 to the fourth, and so on. And these become the weights. And we can see that they're decreasing. So a lot of times traders wonder, why are we only giving 20% to today and 80% to the previous prices? You're not. You're taking 80% of the previous EMA. So if we were to graph these numbers right here, we get these in blue. And look at that, exponential decay. That's why it's called an exponential moving average. It's giving weight to all of these past prices, but it's decaying them exponentially. So if we compare it to a 9-day simple moving average, which is right there, 9-day window would be about 11% each time. But take a look at these orange bars. You see how they give the same weight, about 11% every day, and then bang, just drops right off. That's what we saw before. Once that window slides forward, all of those other prices just completely drop. But that's not true for the EMA. Look at that, they just keep going. Now, technically speaking, mathematically speaking, these things go on forever. So even though we're dealing with a 9-day exponential moving average, we are including prices from 2 weeks ago, from 6 months ago, from 50 years ago. They're all included in there, and that kind of surprises people. Now, from a practical standpoint, what's really in there? And that's really more of what this video is about, what we call the memory of it. How far back does it remember? And there's a couple of good little calculations that you can do and you should know to kind of figure out how far back an EMA actually works. Now, one of those calculations is called a half-life. And what you're going to do, it's going to take a little bit of math, but you're going to take the natural log times 0.5, that's the half, divided by the natural log of 1 minus alpha, which, remember, alpha was 0.2, so this is 0.8. So if you put this in on a calculator, you're going to get minus 0.693 divided by 0.8, and we get 3.1 days. Now, a little side note, if you don't have a natural log on your calculator, you can use a regular log. The key will just say log. Just be consistent. If you use the log here, you need to use the log here. But what does this mean when we get 3.1 days? What it means is that for any given closing price, about every 3 days, its value gets cut in half. Its weight gets cut in half. So think about that. Every 3 days, it had a certain weight, but every 3 days, it's getting chopped in half. So think about it. Pick a number, start dividing by 2, and it doesn't take long before you're dealing with very small numbers. So that's one way to intuitively figure out how quickly that information is going to decay. But probably a better measure, and a simpler one, I'll show you some little shortcuts here in a moment, is what we might call the memory. And a lot of times traders will use a 95% cutoff number. And what you're going to do there is to say, again, natural log of 0.05, and that's just because 95 plus 0.05 is 100%. So if you wanted a 90% cutoff, you would do natural log of 0.10. So if we want 95% of the memory, we're going to take the natural log of 0.05 divided by the natural log of, again, 1 minus alpha. Alpha was 0.2, so this is going to be 0.8. So you punch that into a calculator, you get minus 2.995 divided by minus 0.223, we get 13.4 days. And what that's telling you is that after about 13.4 days, 95% of all that weight has been accounted for. So even though theoretically our 9-day exponential moving average is going back months and years, technically even all the way back to the crash of 29, you can pretty much stop counting after 13 days. So that's what we call the memory. But notice that it's not 9 days. That's what this trader was thinking, that after 9 days it drops off, and that is not true. That's one of the characteristics of an exponential moving average. So if we come back into our Excel spreadsheet, you can see the calculations. Again, 3.1 for the half-life, and the memory is 13.43. So just to show a nice little shortcut, let's go over to this page. And these are various EMAs. I'm counting by tens. Here's a 10-day EMA, a 20-day EMA, and so on, all the way up to a 200. Here are the half-lives that we calculated. And here's the 95% memory level. Now notice something interesting. Over here, if we take this number here, how many days we can remember back, divided by the EMA, we usually get about 1.5, very close. And there's a very good reason for that, but the important point is if you want to know the memory, just take your EMA number and tack on about 50%. So if you're using a 20-day EMA, I know it's going to have about a 30-day memory. There we go, 29.9 days. Again, what that's telling you is that if we go back 30 days, 95% of all of those weights have been accounted for. If you were to add up all of those weights, we would get about 95%. If you're using a 100-day EMA, tack on 50% would be 150. And there we go. That's about how many days it's looking back. So take a look at this. You start using longer EMAs like a 200, they're looking back about 300 days. So again, if you think that it's dropping off after it hits 200 days, that's a simple moving average. It is not an EMA. And so it's not saying that EMAs are good or bad. You just need to be aware of what they're calculating. So some of the problems you can run into, you can get what are called ghost crossovers. If you're looking for, let's say, when the 9-day crosses the 12-day moving average. And what happens because of the way that these exponential moving averages are calculated, you can get crossovers not due to momentum, but just due to noise, and partly because they're looking so far back in time. Now, another thing, if you look at this column, comes up to be 3.5. We're looking at this number, the half-life for the 20-day EMA, and subtract the half-life for the 10-day. And it's a difference of 3.5. So that tells us it's a straight line slope of about 0.35, and because we're increasing by 10, these are going to increase by 3.5. So if you go from a 10-day EMA to a 20, you're going to add about 3.5 days to that half-life. So if you're using a 20 EMA, this means that every 6.9, or roughly every 7 days, any particular weight gets cut in half. And again, it's not going to take long for it to fade. How long? About 30 days. So the main thing that this trader was asking, the main thing from this video, is that if you are using an EMA, whatever number you're picking, tack on about 50%. 100-day EMA, 50% is about 150. That's telling you that if you go back 150 days, that's accounting for about 95% of those closing prices. So why is this important? Well, again, there's a lot of false signals and problems you can get with an EMA, but the main thing is, let's say if you're in something like coming out of COVID, and you think that because you're more than 100 days out that it's not including those prices, which are probably no longer relevant, or during the tariff tantrums, and yet because you're using an EMA, it is including those prices. So that might be a time that you want to shorten up the EMA or possibly flip over to an SMA, a simple moving average. So if we go back to our Tasty Trade platform and look at our NVIDIA candlesticks here, the white is the simple moving average and the red is the exponential. So the first question is, can you tell a really major difference between them? Not really. And that's part of the design. They have the same average lag. But if you look closely, you'll see that the red line, which is the exponential, turns up a little quicker. It also turns down a little quicker. That can be a good thing, but it can also be bad. Because if you're in a sideways market or a choppy market, you're going to get a lot of false signals if you're using crossover patterns. You're also more likely to get these ghost crossovers that are not due to momentum, but just because of the way the calculations are done for an EMA. Whereas if you're using a simple moving average, they tend to get ironed out just because of the calculation there that it's including all of those past prices. So a lot of the problems that we get with the EMA isn't going to be present for the SMA. Now, once again, that's not saying that one is better than another. The point is that you need to know what it is you're looking at. And if you're using an EMA, understand that the prices don't drop off like they do on a simple moving average. The EMA remembers how far back? Roughly 50% of the exponential moving average time frame that you're using. So if you're looking for reliable signals for your trades, you need to understand what signals you're getting. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.